Ever wondered what franking credits in Australia are? Well, you're not alone. Franking credits, also known as imputation credits, are a type of tax credit that companies pass on to their shareholders along with dividends. They're essentially a way for corporations to share the tax they've paid on profits with their investors. Why are they relevant to you as an investor? Well, franking credits can reduce your taxable income, potentially offering significant tax benefits. In the context of Australia, they're particularly important due to the country's unique franking system, which aims to prevent double taxation on dividends. In this video, we're going to break down the concept of franking credits, how they work, and why they matter. We'll run through some examples using 3 different income levels, giving you a clear picture of how franking credits could impact your investment returns. Stay tuned as we delve deeper into understanding the workings of franking credits. So, what exactly are franking credits? You might ask. In the simplest terms, franking credits are a type of tax credit that companies in Australia pass on to their shareholders along with dividends. They represent the tax the company has already paid on its profits, and this amount can be used by shareholders to offset their own personal income tax. It's all part of a system called imputation, which is designed to avoid the double taxation of company profits. Here's how it works. When a company makes a profit, it pays corporate tax on that income. Then, when it distributes some of those profits to shareholders as dividends, those dividends are also subject to personal income tax. Essentially, the same money is taxed twice, once at the corporate level and again at the personal level. But this is where franking credits come into play. The tax the company has already paid is attached to the dividends as franking credits, which shareholders can then use to reduce their own tax liability. Think of it like this. If you're given a gift that's already been wrapped, you wouldn't wrap it again before opening it, would you? The same principle applies here. Franking credits unwrap the tax on dividends, so shareholders aren't taxed again on the same income. Franking credits are a unique feature of the Australian financial system, and they play a crucial role in making it fairer for shareholders. They help to level the playing field by ensuring that income isn't taxed twice, which is especially important for those who rely on dividend income, like retirees. But remember, the value of franking credits can vary depending on the company's tax rate and the rate of tax paid on the dividend. So it's always important to keep this in mind when investing. With that definition in mind, let's explore some practical examples. Consider a person earning a low income, let's say $37,000 annually. Now, let's imagine this person holds shares in an Australian company that pays dividends. When the company pays tax on its profits, and then passes some of those profits on to shareholders in the form of dividends, those dividends come with what's called a franking credit. This is essentially a tax credit that shareholders can use to offset their own tax liability. So, how does this impact our low-income earner? Well, let's say they receive a franked dividend of $2,000, with a franking credit attached worth $857. This credit represents the tax already paid by the company on the profits from which the dividend is drawn. However, as our low-income earner is in the 19% tax bracket, they would usually only need to pay $380 in tax on that $2,000 of income. But because of the franking credit, they've technically already paid $857 in tax. So, what happens to the difference? This is where the benefits of franking credits for low-income earners become clear. The Australian tax system allows for what is known as a refund of excess imputation credits. In simple terms, this means that if the tax already paid by the company and passed on in the form of franking credits exceeds the tax our low-income earner owes, they can claim a refund for the difference. In our example, this would mean a tax refund of $477. In essence, franking credits can provide a significant boost to the after-tax income of low-income earners who invest in shares of Australian companies. They not only reduce the overall tax liability of these individuals, but can also result in a cash refund, which can be a welcome addition to their overall income. This example shows how franking credits can be beneficial for low-income earners. Now, let's consider a person earning a medium income of $90,000 annually. In Australia, the tax rate for this income bracket, as per the current tax system, is 37%. So without any tax relief strategies in place, our medium income earner would be paying a hefty sum of $33,300 in tax. But here's where franking credits come into play. Suppose our medium income earner invests in a company that pays fully franked dividends. Let's say they receive a dividend of $10,000 over the year. This dividend comes with a franking credit. The franking credit is calculated as the corporate tax already paid by the company on its profits, which is currently set at 30%. So, the franking credit attached to this dividend would be $4,286. Now, when it comes time to file the tax return, the Australian Taxation Office considers the sum of the dividend and the franking credit as the individual's income. In our case, this would be $14,286. Now, this is where the magic happens. The tax on this combined amount at the 37% rate would be $5,265. But remember, the company has already paid $3,000, represented by the franking credit. So, the additional tax our medium income earner has to pay is only $2,265. That's a significant reduction from the initial tax amount calculated without considering franking credits. In essence, franking credits act as a tax relief strategy for medium income earners, reducing their overall tax liability and increasing their net income. As we can see, franking credits also have a significant impact on medium income earners. They help to avoid double taxation and can lead to substantial tax savings, making them an attractive feature of investing in Australian companies. Finally, let's examine a high-income earner with an annual income of $180,000. Picture this: you're a high-income earner in the top tax bracket. You have a significant amount of your wealth invested in Australian companies that pay fully franked dividends. So how do franking credits come into play for you? Let's say you receive $10,000 in fully franked dividends. With these dividends comes a franking credit. The franking credit represents the tax the company has already paid on its profits. In this case, the franking credit would be about $4,287. Now, as a high-income earner, your marginal tax rate is 45%. But remember, the company has already paid tax at a rate of 30%. You only need to pay the difference between your marginal tax rate and the company tax rate. So you'd pay 15% on your dividend income. That's $1,500 on your $10,000 dividend. But here's where it gets interesting. You can offset your tax liability with your franking credit. That means you can deduct the $4,287 from your overall tax bill. So what happens if your franking credits exceed your tax liability? Unfortunately, as a high-income earner, you won't get a cash refund. But don't fret. These excess franking credits aren't wasted. They can be carried forward to offset your future tax liabilities. In essence, franking credits for high-income earners like you serve to prevent double taxation and can significantly reduce your tax bill. However, it's also worth noting that franking credits can push your taxable income into a higher bracket, which could potentially result in additional Medicare levy charges. This example illustrates how franking credits can affect high-income earners. Franking credits are a unique feature of the Australian tax system, and understanding how they work can help you make more informed decisions about your investments. So, we've explored what franking credits are and how they impact different income groups. To recap, franking credits are a kind of tax credit that companies in Australia can pass on to their shareholders. They're designed to prevent the double taxation of dividends, ensuring that profits are taxed only once. This means more money in the pockets of investors. We've seen how franking credits can make a significant difference for investors across the income spectrum. For those with a low income, franking credits can often mean a tax refund. For those in the middle, they can help to reduce the overall tax burden. And for high earners, they can provide a useful way to offset other tax liabilities. But it's crucial to keep in mind that everyone's financial situation is unique. What works for one person may not work for another. Remember, this video is not financial advice. Always consult with your financial advisor before making any investments.